My client Naresh came to me and told me, Tapan, I have invested in a particular stock at 100 rupees. Now it is just 5 rupees. People are sell this stock, it is of no use. But I am not going to sell it. Even though I have lost everything, why should I sell? Again, another client, Ronish, come to me and told me, Tapan, I am not going to invest in stock market. There is so much of volatility, and I have seen people are losing money like anything. I am just okay with the fixed investment, that is fixed deposit, and whatever I get 5-6%, I am okay with it. Now this type of various type of clients and investors I am facing every day, and everyone has their own emotions running around their mind and thinking about what to do in market and what not to do. And I want to tell you one thing: in market, more than 60 to 65% of your success is depend on your how you have of stock market mindset and what type of mindset you have, and also how you are able to control your emotions plays a big role in stock market. So guys, hello and welcome to my YouTube channel. My name is CA Tapan Doshi, and guys, today we are going to talk in detail about behavior finance. Okay, so stay till then, because I am going to tell you how emotions plays a big role in the stock market, whether to do take a decision or not to take a decision. That is a thing, whether to do or not to do. That is what we are going to talk about it, and how people are struggling in this context. So let's start, and welcome to my YouTube channel. So guys, the first thing we have to understand is that first behavior finance funda is loss aversion. Now what is loss aversion? Now people are not investing in a market because they think it is very much volatile and it is very risky to do it. People will say, boss, I will invest in FD, I will invest in another bonds where there is a fixed income, but I am not going to invest in the market, because they are seeing sometimes so much of blood in the market. No, because if the market falls, of course there will be a lot of loss, whoever is taking risky bets and everything, and once they see that, they feel no, in market everyone loses. So a particular segment of people losing, and they make it for the whole market. And that is a thing, most of the people emotionally feel that stock market is a place where there is a big gambling going on, and people are losing money at like anything, and that is why they don't want to invest in market, and that is called the loss aversion. Loss aversion plays a big role. The reason is simple: you are just replicating one small community where who has lost money by doing betting and intraday trading and whatever it is, and you are taking that example and you are thinking that the whole community is like that. But frankly speaking, it is not like that. You also know that you can make a big money in stock market if you do a long-term investing. And guys, if you want to understand more about long-term investing, just click below link where I am going to talk in detail about how to do a long-term investing through a master class, 2 hours master class. You can join that master class, the link is given below. So coming to the topic, this is the where most of the people struggle to control their emotion, to control their mindset. Another important behavior is sunk cost fallacy. Now what is sunk cost fallacy? Now, as I given you example earlier, suppose you have invested rupees 100 in a particular stock, and that stock price is also 100, and you have bought only one share. Now that share price gone down to basically 80, then you may be losing 20 rupees, correct? So you will say, no boss, I cannot lose money, so let me there, whatever it is, it will come up. Even though back of the mind, subconsciously you know that this share, for this share to come up again, it will be difficult, but then also you stay invested. Again it goes to 20 and maybe 10 also, and it goes down and down, but then at that time you will think, boss, I am already lost most of my money, then why should I sell? Just stay in future. If my मेरा नसीब होगा, if my faith is there, then stock may go up, and at that time I lose money. And that is a sunk cost fallacy. Now in sunk cost fallacy, you feel that, boss, I don't want to book loss, I just want to stay there only, and just thinking and just praying that stock price will come up in future. And that is a thing you have to keep in mind, that this type of emotion literally bring your capital to zero. Because suppose you are invested in a Yes Bank or DHFL at a higher level, maybe 300 400 level, and if you are not got out till the end, then DHFL got unlisted. However, Yes Bank, yes, they now it is around 13 to 14 rupees. But what is the point? The point is saying that in sunk cost fallacy, you don't want to take that aspects, yes, that the stock is not good, and if it is going down later, better to sell it. But at that time, emotions literally control our mind and we are unable to take decision, and that is where the problem is created. So we have to keep this point also in mind. Another important point in behavior finance is nothing but endowment effect. Now what is endowment effect? It is thinking like whatever I am owning is the best thing in the market. For example, suppose you have invested 50,000 rupees in a particular stock, and that stock is literally going down, but you want to train your mind, no boss, something will come good, I have done so much of research, I should not go wrong, or I will not go wrong, and that is why you are thinking, no, this stock will come up. However, the fundamental of that stock is going deteriorated, then also you are not getting out, and that is called an endowment effect, that the shares what I own is much more valuable for me, I cannot lose that share, I cannot have a loss on that share, and other share may go down but my share will never go down, and that is called an endowment effect. Now here the emotion of owning that share is literally taking over you, and you are ignoring all the negative news coming for that stock. And if you are doing the same, suppose you have a stock which has gone down by 30 to 40% and still negative news are coming for that stock across the board, and management is not doing great and all that stuff, and finance is not doing it, then you have to take notice of it. Otherwise this endowment effect will literally bring your stock to zero, because that endowment effect nothing but whatever I own that should be a good stock and it is much more valuable for me, and that is completely wrong. Whenever you analyzing that stock, think like a third party, think as a no different person, and think whether the stock is at a current level, even though it is 40%, is it really valuable to keep that stock in my kitty or not? If you feel no, it is not, then better to sell this stock. So that is a point, endowment effect, and that is a problem. No, when there is an endowment effect is there, no, you average every time whenever the stock is going down, because you feel that stock price is going down and it is getting you are getting that stock at a cheaper level. But you have to understand, guys, if the stock is falling by 40 to 50%, that means there is fundamentally going wrong in that stock, and you have to take notice of it. If you don't take notice of it, then you are averaging every time, then you are making a biggest mistake. Most of your capital will go in that stock, and that stock may not come up again, and you will lose lot of capital, and then at the end you will blame the market. Now the market is nothing to do with it, it is your decision to average it. And I want to tell you who are the successful people. Successful investor normally averages on a upside. Whenever the stock going up, they average it, not when they are going down. Normally whenever they go down, they do an average one or twice, otherwise they will stop and they will see whether the stock is strong enough to keep it in their portfolio or not. If it is not, they will literally sell that stock even at losses. If you talk about Rakesh Junjunwala, guys, more than 33% of his wealth is created by Titan. Now you may say that yes, he was a knowledgeable person, but guys, understand, when he invested first time in the Titan, he is having a small chunk of only stock, correct? But afterwards, when the stock started going up, he every time assessed that stock quarterly result, and then he reinvested another installment, another amount in that stock, and that is why he averaged at a higher level. And that is what you have to do, guys. Okay, average the stock at a higher level, not at a lower level. So this endowment effect plays a big role. Another important behavioral aspect, that is the fourth number, is nothing but decision paralysis. Now market is so volatile overall, correct? Now it is going up and down, and something happening at a global level, it is impacting our market. And because when the market is going such up and down, normally people who are not too much sure whether to invest or, they go on a decision paralysis mode. they'll towards status quo, that let us not invest in a market because I don't know what is going on in the market, and they literally don't take any decision. And that emotions, no, whether I'll get wrong, whether when I'll invest the stock will go wrong, or which stock to invest. So there are so many decisions to be taken, and at the end they do a decision paralysis, and they literally don't invest in the market. Now when you face this type of issue, better to give it to the fund manager, better to give it to a portfolio manager. You can invest through a mutual fund where no, they take a decision on behalf of you, and that is the how you have to do. But don't bring decision paralysis in your mind, because overall if you see last 43 years Indian market has given more than 15% of return, CAGR 15% of return. Now that type of return India has given, and in future next 10 years India may give more than 15% of CAGR. Now when you getting this type of return, better to take a well informed decision, and if you are not able to take a decision, better to give it to the mutual fund or invest through SIP in the mutual fund, or to give it a portfolio manager. But don't bring a decision paralysis mode. So all these are behavior aspects you have to consider, because emotions plays a big role. Even if you consider another important fifth thing I want to talk about is nothing but FOMO, fear of missing out. In FOMO, when a person sees his relative friends are investing in a particular stock and they are earning very good money, then what he will think? He will think, let me invest in the stock, otherwise I will be left alone. And that is why he is going and investing in a stock at a higher level. Even though at the back of the mind he knows that the valuation on a higher side, but that fear of missing out feeling is so high that he literally take over its mind, and they invest in that stock at a higher level. Now that feeling you have to get out of it, because fear of the missing out is one of the main reason why most of the people invest at a higher level. So guys, these are few of the actually behavior aspects you have to consider when you invest in a stock market, that is loss aversion, sunk cost fallacy, decision paralysis, status quo, again FOMO. All these are some of the real reasons why an individual is struggling in Indian stock market. You have to keep in mind, because all this plays a big role when you invest in a market. And that is why every time it is been said that in stock market 60 to 65% of your success depends on your mindset, and that is what you have to work on it. So guys, hope you like this video. And if you want to get in touch with all these type of videos, which I am also going to bring in future also, just like the below button and subscribe to my channel, and I see you in the next video. Me, Tapan Doshi, signing off. Thank you.